So once the price shifted all the way to the premium, we saw a level, that's a level of interest. LOI is a level of or point of interest in the market that we saw. And it was agreeing to our levels. So obviously once we see that on like the 4-hour chart, we're gonna wanna go deeper because we execute basically based off like the 5-minute chart, right? So with this strategy here, it's gonna help us see the 5-minute chart much better once we are at our levels of interest or points of interest. You see, so just keep this one in mind, this signal here in mind. So as you can see, that's where the market was. If I shift it a bit to the side, this is basically where the market was. See that? This was where the market was when the signal was released, was already released, because it was released before that. Yeah. So it was released around there. So then it started just trailing down. I actually want to look for the pure signal. Okay, I'm just having trouble trying to find it throughout all of these signals as well. Okay, it might be a job and a half, but you kind of get the idea of what I'm trying to say. Yeah, so basically the price was there, and once we saw the price was there, now we had to go to our bag of strategies and then pull out our ICT strategy, which is the one that's going to help us basically measure our inputs into our trade. So if we just recreate it quick, so this is where our discount was at. See, so we measured our discount here and our premium, and I still hope you know how we determine our premium and discount on levels.
I thought
Okay,
we
yeah.
still use the fib levels, right?
Oh yeah. That's the sweet spot.
Yes,
So we went into our fib levels. We grabbed the whole trade that we are looking at, which is around about there, and we saw that this level is close to like our 80%, gravitational level. So we can consider this as our discount. This is our discount level between these areas. And you see the closest order block, which is closest to our 80% mark, is this one here. So there's the confluence for our discount. So now we've determined where our discount is. We can see our supply is here, our demand is here. Supply and demand, there's our discount. We need to identify our discount and premium. And the trade we were trying to catch was a premium trade. So we know that premium trades go for like, a few days or so. Yeah, so once we saw, we started to notice where our discount is, our premium is. So like I was saying a week before, I actually had the signal set here on that week to be here, but then it reacted by the discount and then it left. So we didn't catch that trade, but it always has to come back to the premium. Like I won't lie, like the institutional trade will have to come back to the premium. So they rose the price again and they brought it here. So in this instance, we're just gonna go into depth on this ICT movement. So we have to go to like the 5-minute chart. So we're gonna see how we would have traded this movement there.
On the premium.
Yeah, on the premium. So this is where the premium was. Yeah, after this huge run. Yep. So this is where our premium have been. So after this huge run, as you can see also, there was a whole lot of liquidity on this side, so it had to rush up. So the discount was just used to put in more liquidity into the market at this point. You see, so yeah, there was a lot of liquidity here. The institutions came and collected all of that liquidity that was being made on the downside. So let's just zoom in, and then we're coming closer to this level here. So this will require you to basically know all of the sessions, but you do know that the Asian, London, and the New Yorks are the one that are usually handling the markets interdaily, right? So the strategy is called ICT, which is inter-cycle trading, which means that you can, it's a cycle, you see. So every day, this is the type of movement that happens. So first we're gonna need to mark our, basically where our Asian is. So let's start here on Thursday. This was Thursday on the 1st of December. This was a day before NFP, which is where the market started moving from the zone. So we know that markets open around about 12:30 New Asian time, which will be like midnight, basically. Midnight is when they will open. So they will run until 8:30. 8:30, which will be your Asian, you see. So basically during the Asian time, nothing happens in the market, you know. It's usually just more orders being collected or the market rushing to a certain price. So after then, you're going to need to mark your London session, which the Londons are only in session between 8:30 till 4:30. You see, so that gives them that whole 8 hours for them to control the market. Then after then, the New York session only starts at 4:30. So usually when people knock off in this country, that's when the New York session starts, and that's where we're basically going to catch the trades in the New York session. You see, because the New York session has more confluence, especially when it comes to NAS, since most of the US most of the companies that are backing NASDAQ are like from the US. Not even most, all of the companies backing NASDAQ are from the USA. You see, so
what time does the US market open? Like on their side, like around 8 o'clock.
yeah, for them it will be like 8:30. You know, it'll be like 8:30 for them. But in our time zone, it's gonna be 4:30, you know. So I don't want you to use a New York time zone because it's gonna end up being tricky for you, you know what I'm saying? Because I also tried using the USA time zone, and then I always have to go backlog and check time zones, you know, and check like how many additions of hours are there. So it's just better to use the Joburg time, you know. It still works. Yeah, you can still use
So
the USA. It's just gonna be a bit confusing. I don't wanna lie, because we also don't use that time, to be honest.
so what you're saying is when it's 8 o'clock on their side, so it's probably like around 4 to 5 around our side.
Yeah, it's about 4 to 5 because I have a session which but it also depends on where in New York, you know, it will be that.
Yeah.
But if you have to go maybe to somewhere like Los Angeles or something, which is on the other side of America, it'll probably be a different story. Because we just go,
Yeah.
yeah, when we look at America, we usually work with New York because that's where the stock exchanges and that's the time they are using, you see.
I bet.
Yeah, because I have sessions with this other guy that side, and when it's 10:30 on his side in the morning, it's around about 8 o'clock on our side. See, so yeah, but he's all the way in Los Angeles, not New York, so that's an extra 2 hours on top of the New York.
Okay. I feel you.
So when the stock exchange opens is 4:30. See, so I'm gonna just go in depth. So Asian, we're not looking at Asian, so we can just cancel out Asian. Let's just focus on our New York session and our London session. And let's see. So basically the rules of this strategy, and you have to note them. They're very easy to remember. I won't lie. So what happens in the market is that when the London session opens, you see, you have to mark three things in the London session. You have to firstly mark where the London session opens. So usually where the London session opens, it will be kind of our equilibrium to the market. You know, that's our equilibrium, our middle point. You would say our median in some jargons. So marking the London open. So that's where the London open. So then from there, we're going to need to mark two things. And then we're going to need to mark the London high and the London low, you see. But those will end up finding as like when the market is about to close or so, you see. So for that time, you can also trade the London session if you want, because some trades do also get released during the London session as well, just also depending on what your SMC analysis is also saying and the levels as well. So here you can see that it's basically been at the premium. After the London came, it left the premium. It came back. So it leaving the premium was it just creating a low on the intercycle level, you see. So it was just creating a low to show us on the 5-minute, and then this is where our low was. So we're gonna need to stretch that low throughout the New York session, because that is what is gonna guide us on how our New York session is gonna go. So then we have the London low. There's our London low, and then we have to mark our London high as well. So I don't know if you already see some confluence into this strategy. So there we have it. We have successfully identified our London low and our London high. So our London high and our London low ends up creating liquidity on both sides. So we end up having a buy side liquidity and we end up having a sell side liquidity. So let's say we gotta mark where is our buy side and sell side liquidity. So there we've marked, this is where our buy side liquidity is, as the buy side liquidity is where the high is, and our sell side liquidity is basically where our sell is. So the London markets have basically created these two sides of liquidities by creating its high and its low, you see. And now we see that the London open is basically like the median, you see. It's like the middle range of the market, you see that. So how our strategy dictates is that whichever liquidity is taken out first, the trade will be on the reversal, you see. So for instance, especially in this part here, if the London high is taken out first and the buy side liquidity is collected, the main trade of the New York session is basically going to be a sell, which is coming to collect the sell side liquidity. Because now, since the buy side liquidity has been taken out, there's a level of insufficiency on top of that liquidity, you know. So the market cannot go there because they've already taken out the liquidity, you see. So in this instance, if the market also opens up where, let's say, the London session closes where the London high is and the New York session opens where the London high is, then the market will also inversely go and collect the sell side liquidity, because that buy side liquidity has already been collected or exhausted throughout the previous London session. You see that? So for an example, if you see here, there's a nice little top here. So for example, you can see that after the London open came in, they created the low, they passed the open, going to create the high. There was a spike, and then they created the high, brought it down to the middle, you see. So they opened up the New York on the middle. Once they opened it up after 4:30, it went to go take out that buy side liquidity, and it took out the London high, and that time it was already an order on the 5-minute chart. There was already it had already created an order after this quick up and down movement. You see that? So once it goes up, now we see that it's in the premium of our 1 hour, and now that it's collecting an order here, so that's more confluence. So once it takes out the buy side liquidity, we have to check that, is it in an order block, first of all, after it takes out the buy side liquidity, or once it takes out the buy side liquidity, is it rushing to an order block, or maybe to a point of interest within our 1 hour? If it's already there, is it in our 5-minute order block as well? You see, so then we have to look at all of these different things at the same time. So if we just take it out a bit and just view it on the broader spectrum here, so it would be that we saw it here on our premium price, saw it there on our premium. We saw where the discount is 20% difference, and we're looking for a reaction, so it could have been that we could have even caught this trade here, but it wouldn't have been wise to catch it here, because this is the Asian session, you see.
Yeah.
So there's no use catching it in the Asian session. There's still two more powerful sessions that can swing the market in either directions, but it wouldn't have been an issue to still catch it there, as long as you have a nice stop loss. You can afford a big ass stop loss, you see, because the London and New York are gonna wind the market up. So from this point, it would have been wise to either catch it on the London or the New York. To be honest, it would have been the best on the New York. The New York session is, would have been the best to catch it, because we already
After
seen.
it grabbed that, so you set your order block by that liquidity that the London market left.
Yeah, I would have set my order by, that high, which the London would have left. But then again, like once the London it leaves that high, all I have to do is I have to wait and see which liquidity does the New York session take out first. You see,
Okay.
it's a waiting game when it comes to this strategy. So, like after they left it here, if they would have went straight down and took out this side, I would have been prepared that, okay, it's in my discount now, and it's bound to go back to the premium. You see what I'm saying?
Yeah.
And then I
You're
would
gonna
have
prepare
bought
to
this,
buy.
and I was prepared to buy. You see what I'm saying? I would have prepared to buy this, and then it went up, because this is not a hectic movement down. So there's no momentum in this market, as much momentum. You see, so it would have still went to the premium, because if there was too much, it would have left the premium just quick. And then you can see that it double top there, and it's a head and shoulder here. To it is a shoulder, and then it's a head here. You see that? So there's also a formation that's being formed there within these sessions here. You see, so you must know that the market is just it's a whole big thing, which these three guys just pass on to each other. As the time comes, they pass on to each other. Maybe one person is there to create the liquidity. Once they pass on the market to the next guy is there to collect it. And then when they pass it on to the next guy is just there to bring in the traders into the market, or they just there to just put the market at equilibrium and stuff like that, you see. So with all these sessions, all of these tasks or jobs have to be done by basically different people, you see that. So
Yeah.
once now like the basis, basically the theory of this strategy, you can start to identify movements better. You can start to know where to execute based on like the 5 minute. So this is what we use when like we give out signals on like the, let's say like the 1 hour, we give out signals and we know levels. But for you to execute, you need to basically deploy this, especially on NAS. Especially on NAS. This works beautifully on NAS. So the nice trade to catch would have been here, would have been a short once we see the market take out our buy side liquidity, and we would have bet it to take the market down, and then we would have collected profits there by this level here, you see. But it wasn't the trade that we were looking for, you see, for instance, which is why I hopped out here. Because it wasn't that institutional trade that I was looking for. But the next day was NFP, which was last week. It's just that I was a bit busy. I was going to Rusty on that Friday because the whole ceremony was happening. So I was just on the road. I wasn't on the markets. So let's say, okay, we scrapped that day. That day is out. And now it's a new day. So it's an ICT, it's an intercycle trading strategy. So this is from 12. The Asians are on the market until 8:30. It's a new day. We mark our new alignments. It's 8:30, and then we're gonna see where the London end off. And then the London was about there. The London was about on that level there, which is basically like the middle. So we gotta mark our Asian.
So it's 8 hours each.
Yeah, break it down to 8 hours each, 24 hours in a day, or 23 hours within that market, within the market day of the whole duration. London. And we have New York. New York till, yeah, so now we can see that, okay, Asian, not really that worthy. And then now we're here on, it's a new day, it's our London. So our price is still playing between the discount and the demand. You see that? So in this area, we gotta mark our open as well. Mark our London open. Open, mark our London high, which is so conveniently where our premium is. So we would have been trying to sell the premium for as long as it takes until there's a reaction. So every day we would just wait for the premium and sell by the premium. If our price doesn't react by our premium, we take whatever profits we can, and we still wait for that that whole institutional movement. So we have our London low, buy side liquidity, sell side liquidity. So London opened, it went up. 2:30 is when our non-farm payroll was released. So then obviously we got a reaction, which was by the London session as well. Got a reaction. And then They took out a portion of the market, took out a bit of a portion of the market. They didn't take out the whole liquidity. They took out a portion. So due to the results, we got a reaction during our London session. Like I said, like some of these trades can be executed throughout the London session, basically. So in this market here, we can see that there's going to be an overlap of liquidity left in the market. So we can see that in actual fact, on this day, the London liquid buy side and sell side liquidity was not taken out on this day. And it does happen. And when such things happen where the liquidity is not taken out, it means that it's compounding liquidity. And when it compounds liquidity, it means that the market is basically getting ready for a big movement, you know, a huge movement in a certain direction here. So once this reaction happened down, the New York came in and basically put the markets at equilibrium. It just equalized the markets, try to fill in the gap as quick as it can from that London movement. But by it filling up the gap, it did not take out any liquidity, which is either on the high side or the low side. You see that? So we would have chowed the NFP by the premium here. That would have been our trade of the day. The signal was actually really, I did release the signal in the morning to this level here. So that the gents should have chowed, but I didn't chow due to the traveling. But yeah, the gents should have chowed. This would have been our trade by the premium. London opens. After London opens, it rushes to the premium. We'd have placed in that trade. We'd have caught it until day. You know, since it fell on a 5 minute, yeah, I would have exited out somewhere around here. Once I start seeing this pattern here, this pattern forming here, and then I would have exited out of the trade. And then that would have been that for the day on my side. So now the liquidity was gapped in during the New York session. So now it's a Monday. Let's just mark the New York. So usually Monday, nothing happens actually. So unless it's just shifting from a zone, but usually nothing really happens. But it's always good to just keep track of what was going on in the weekend. And because this also helps you to identify where liquidity is being compounded at, you know, to see the compound of liquidity. And then we're still trying to monitor where our, you know, London low and high liquidity is going to be taken out. Okay, so stretch it there. So would have been an Asian, would have been the London. And then the New York. It would have been still, it would have been New York, and then would have closed in New York around 1. So we can see that in this instance here, there was a high created. You can see there was a high created. There was a low created as well. So this high was not taken out. So there's 2 compounded highs already in this market, you see. So at this point, this market has already taken reaction from our premium, you see. So I think the institutions are trying to shift this market down to basically where our demand is, you see. So they've probably fulfilled enough orders at this point in order to shift the market and change its whole character. So another compound of buy side liquidity, the market opened up, the low side was here, opened up, it took out the low side, and it went to to this low side here, but still didn't take it out. Still didn't take out that low side, still didn't take out that high side, and it still compounded another high on this point. So, and then the Asians come in as well. Now you see that it keeps compounding these highs and buys. So well, this is what shows us that we are basically in a selling market. The selling power is too much. Bro, this session is about to stop. So we'll just open up another link, the same link, and then just continue on this. Just give me like another 10 minutes in order for this video to finish converting, and then yeah, we'll get back in.
Okay, I bet. So we're stopping the session now.
Yeah, and then we're just gonna, because I'm only left with a minute on this.
Okay, I bet, bro.
All right.